2023, baby! Happy New Year to you. And with the 2020 year finally complete, it's time to look at the data and the trends and kind of specifically what we should really be paying attention to in this year of 2023. This is going to be a good one because I'm going to take you from the micro all the way to the macro and all the things that I'm looking at right now. And if you are looking for some help on how to navigate this real estate market, specifically in 2023, now that we're here, you could do so by booking a call with me using the link that's on the screen. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and a question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zen and I run and operate a Remax brokerage in the greater Toronto area on top of making awesome real estate content just like this for you. Happy New Year. Like I said in the beginning, I really hope you enjoyed your time off. I definitely enjoyed my time off. Now, I have a special treat for you because during the holidays, in between friends, families, and all of the gatherings that we have, I was compiling a massive amount of data to kind of show you what I am looking at and what happened in 2022 to give you an idea of kind of indications, trends to watch, and some things to kind of basically kind of call it quasi forecast and things that we're running into in 23 because, I like data. So without further ado, let's get started. We're going to start looking at first the historical sales and the number of transactions. Now we're going to start with freehold properties, so we call them single families. And basically this is everything except condos, including condo towns. Now you can see in this chart over here, it goes back to 2013, so it's almost a decade. And that little dotted black line I'm gonna point out for you is the performance of 2022. Now, the December numbers aren't fully in yet because they haven't been reported by our real estate board, but the initial numbers basically shows that we had less sales than the month of April 2020, which was the month of the pandemic. It was that slow. Now, December is kind of an outlier month, so I wouldn't take it with a huge grain of salt. But if you look at the chart here, you can kind of see that the first quarter, the first 3 months had crazy ramp up in sales. And then the number of sales became essentially like a 10-year low for freehold, right? Strange? Well, you could basically attribute that behavior to people not buying or there was no stuff to buy in the latter half of the year, the last 3 quarters. And that would kind of be, like say, my initial thought to why sales are so low. So this next chart here is the 10-year historic norm of active listings, right? So you could see that in 2022, it wasn't actually the worst year for, active listings. And if you kind of need like a reminder, the active listings are the number of properties at the end of the month that didn't sell and are still available to be bought, right? So 2022 saw like the third lowest number of properties remaining, only behind 2016 and 2021. And if you remember, the reason those 2 years had such a low amount of sales is because we had the biggest run up in price before the quote unquote crash, which happened respectively in April 2017 and April 2022. Just coincidence, April. Meaning all the properties that were bought and there really wasn't much left at the end of the month. Hence the active listings were very low. So to see the freehold inventory remain that low does show that there really isn't much stuff to buy at the end of each month. And to confirm this, we look at new listings, right? To make sure that, we had enough. And you can see over here, basically in 2022, it started within reason, meaning a reasonable amount of new listings in the first quarter, then it just fell off and then fell off some more in September, like I was saying. Because if you kind of remember September 2022, everyone was kind of waiting for the trigger rate sales, but nothing, crickets. Now, if we look at this chart here, it's the months of data as of November. Again, December's not out yet, but it's a bit above the average for the last 10 years in November. But I wouldn't be surprised if it continues going up from here on, meaning in the start of the year. So the question for what's on the horizon is always how many people are going to need to list. That's going to increase the supply, which decreases the price, right? Now, if you note, this month's of inventory data does, fluctuate seasonally, and we probably won't get a good picture of it until Q2 2022. That's what I've been saying for a while. Now, let's look at condos, which is the exact opposite, no freeholds. And you can see right here, very, very strong sales in the first quarter of 2022, similar to freeholds. And then it fell tremendously, making 2022 the worst performer in the last decade. Oof. Yeah, right? Now, the drop I would say kind of mirrored the sales volume during the pandemic year, which is 2020. And you can see in this chart over here that the inventory kind of started off very low and sales were high, which is why prices went up, right? Similar to the freeholds. But now the inventory was kind of about where it was in the last 5 years. Now, this is what I was warning about in September. The inventory levels for condos were getting quite high. Now, the prices are quite stable. That's a, silver lining to it. But if I were an investor that has to deleverage because of interest rates, it's always going to be the condo first. And with the investors no longer buying condos because, crazy negative cash flow numbers like minus 1,500 and it doesn't make any sense anymore, the buyer pool has diminished, leaving only to end users buying it. Now, the saving grace in the condo inventory right now is similar to that of the freehold. It started very, very strong with a lot of new listings and a lot of sales in the first half. And then just like the freehold, crickets, it paused. There were no new listings that kind of came up and it kept the listing count very, very low. So when you have inventory building and new listings down, it means that the buyer demand is still very low, but because there's new listings that are very low, it's suppressing the prices a little bit. And you can see that in the November numbers. The months of inventory is also above the norm. It's relatively high right now at 3.5 because you have to remember, we've been so used to seeing condo inventories around like 1 or 2 months in the last 6 years of the massive condo bull run that this 3.5 months is a bit concerning. Now, again, like I've been saying since September, the excess inventory is required for a price drop, but that price drop hasn't materialized yet because prices are quite stable. Now, if you take 2020, because of the pandemic and the massive surge of new listings we saw in September, like shortly after the pandemic, you could effectively see that we have approximately 3 times the inventory that we've had in the last 6 years going into basically a 2023 condo market. So again, the question is, who needs to sell? And now here's our final chart in regards to inventory, which kind of basically summarizes everything. So freeholds and condos, you could effectively see that like similar to across the board for all things, new listings was very strong up until about March, right, which is the first quarter. Then they fell off a cliff and then continued falling off a cliff in December, despite all the chatter about the trigger rate sales, right? So that's kind of what happened in 2022 from an inventory perspective. And that kind of lack of inventory is a saving grace right now for all prices. But, still not much to buy. That's why if you find a good property, a lot of people are still buying it. Now, if you found this helpful, make sure you help me smash the like button and share this with your family or friends, anyone who's kind of into the real estate space. Because the idea for me putting this out there is kind of provide a bigger picture perspective to really what's going on and the nitty gritty of all the things that are micro. And I'm going to talk about all things that are macro about the market to give you a holistic approach to kind of what I'm seeing in the market with the data, right? And while you're at it, a subscribe will be much appreciated. And if you know someone or even yourself is looking to make a move in the real estate market this year, and you kind of want the help of my kind of data-driven approach, you can book a call with me using the link that's right here. It's www.chatwithzen.com. And, I'm looking forward to helping you guys make a move in 2023, whether that's on the offensive or on the defensive. Now, let's talk about, rates, what a lot of people have been asking me about recently, especially even the holidays. Last year, towards the end of the year, we saw the fixed become lower than the variable, which, for a few months is kind of rare. And we even saw that the shorter term fixed, meaning like the 2 years and the 3 years, lower than the 5 year, which is a little bit unusual. And that's because the yield curve is inverted. You don't have to understand fully what that means, but it's just, that's how weird it is economically we're in right now. So what that effectively kind of means on our perspective, it means that the shorter term stuff is paying more than the longer term stuff, which effectively is a signal for recession. Okay, I'll just leave it at that. Now you got to remember, the fixed rate mortgages are tied to that bond market I was talking about. And despite its kind of incredible volatility that I put over here, you can see in 2022 with like massive swings of like 50 basis points really quick, it is still at the end of the day up to the banks to change their fixed rate mortgage products, whether the mortgage rates for fixed go up or down. Now, I only personally saw one bank drop their fixed rates by like 15 basis points when the 5-year bond came down 60 basis points. So ultimately, this shows you that the banks are still controlling the fixed rates, and any kind of swing or talk about the 5-year bond, it's going to take some time for it to be integrated into kind of the mortgage rates, right? And as you know, with the variable, it's tied to the Bank of Canada's overnight rate. Next one is January 25th. So what's changed when it comes to kind of consumer mortgage originations with this kind of dynamic shift? You can see in this chart here that more than a third of the mortgage borrowers as of late has been picking a fixed rate mortgage of less than 3 years. The variable was incredibly popular, after Bank of Canada Tiff Macklem was saying no rate hikes until 2023. Yeah. But as you can see in the chart, right, effectively 2/3 of the origination was in that camp, but now it's less than 1/3 that's actually getting the variable. And the fact that the 5-year fixed, right, isn't as popular in the Canadian borrower zeitgeist right now tells me that the Canadians are confident that the rates are coming down before that 5-year term comes on the mortgage. Now, again, the risk tolerance of each mortgage product comes down to ultimately you, the borrower, or whoever it is that's borrowing for the mortgage. And even the most conservative people I've talked to about interest rates, they're not taking more than a 3-year fix because they also believe that the interest rates are coming down. So again, this tells you a little something about kind of how Canadians are thinking, what the zeitgeist is right now, and where they think the rates will be in the future, because data says it. Now, one of the super interesting charts that I have here is how much principal mortgage paydown has occurred through, the last decade. And if you look here in the last decade, so obviously with like mortgage getting bigger and bigger, with prices also getting higher and higher, the amount of principal, meaning the mortgage paydown you have, does increase over time with the exception of 2 periods, which I've highlighted here. So you can see in 2020, second quarter, the pandemic, when there was mortgage deferrals, which allowed a lot of mortgage borrowers and households to effectively pause their mortgage payments for 6 months. And if I recall correctly, in some special instances, you could amortize and extend out your mortgage if you were unable to kind of make the payments and you can prove that you needed some financial assistance. So that period, the amount of mortgage paydown kind of paused because no one's making a mortgage payment, right? Because you just have to check a box or call them to get a 6-month deferral. Meaning that because of that mortgage paydown, you kind of see that little dip in the chart, which is the first one. Now, the second one was recently due to trigger rates. When the mortgage borrower, especially with like the non-Scotia mortgages, hit their trigger rates, they're essentially only paying interest only, meaning there's no money going towards the principal. There's no mortgage paydown. Hence, it dipped again in 2022, the second half. Now, the insured mortgages, which were the mortgages less than 20% for a down payment, were effectively allowed to re-amortize from 25 years to 40 years if you could prove, again, you needed financial assistance. I think this was in Sagan. And that was kind of a way to kind of also reduce the mortgage paydown. So you can effectively see that in the last 2 years, we've seen some kind of government intervention regarding mortgages or like, what some people are calling a bailout for mortgage borrowers because the banks effectively don't want to go through the process of power of sale in Ontario to take your property back and sell it. So for the mortgage borrower, this mortgage is their liability, but for the bank, this is their asset. However, if the asset goes underwater, instances kind of like if the mortgage is more than what the property is worth because the market's gone down, that becomes the bank's problem and liability. Hence, they have these loan loss provisions that have been increasing. So this is something for you to keep in mind going into this year because, in the last 2 years, it's already happened twice already. So call it a quasi bailout or like a kicking the can down the road, whatever you want, right? So I personally wouldn't be surprised if we saw some variation of this happen again in the market if it gets bad enough. But keep this in mind. Don't take this as a bailout is coming. But if there needs to be some kind of like solution because things are blowing up massively and there's tons of mortgage delinquency, I would not be shocked if we see something like this happen. Because remember, some banks are already allowing you to negative amortize right now. Now, let's talk about the next thing, which is the population growth. Now, before anyone thinks this is going to be the saving grace for the real estate market in 2023, let me make this super duper clear. Immigration in 2023 is not going to be the saving grace. And I've said this for the last 6 months. The short-term stuff is dictated by the micro, which we talked about earlier, which is supply and demand. The medium term will be dictated by rates, which I just talked about, call it 6 months plus. And the long term is going to be affected by a lot of population and the lack of land, which probably won't kind of create its effect until call it 5-year plus. So you can see in this chart here in 2022, we had a staggering 860,000 new people come into the country. That's wild. 500,000 of those are supposed to be the targeted permanent residents, but that number on the chart here includes the non-permanent residents such as students and kind of temporary workers on like a visa, right? Now, this chart that's even more interesting is that you can see the non-permanent residents that has grown in Canada as like a percentage of the total population is crazy. It's doubled in 7 years, meaning that we're bringing a lot of people in, right? Because, I don't think we're, creating enough kids in Canada, right? But effectively, that's Canada's superpower. And we let people into the country. Now, if you specifically look at Ontario, you can see about like 40% of that 860,000 made it into Ontario. That's about 350,000. For reference, 350 is equivalent to a city of Markham or Vaughan coming into Ontario each year. That's wild, right? So we saw that last year. Now, one of the arguments for a lot of people in the bear case of the real estate market are there's countless stories by the media constantly being reported that there's a large amount of people in the millennials leaving Ontario, a huge exodus. Look, here's the data right now straight from StatsCan in regards to the population movement in Ontario of permanent residents. And you could effectively see last year, yes, there were a lot of people who did move out, but despite all this chatter about the net immigration of permanent residents outside of Ontario, Ontario's still positive, which brings up the question, are we going to have a supply crisis at some point? My answer for you, at the moment, nope, definitely not. But we're definitely set up for some kind of crisis in the future because of the way we keep bringing people in and the way we're not building anything right now. Now, when we look at the properties that are currently under construction, we have a very, very strong supply pipeline, I would say, for the next few years. That's why I was saying immigration won't make a difference for a large time in the population growth side, right? But I would also argue that in the high-rise purpose-built apartments and even condos, I think we may be oversupplied for like this quarter and maybe the next one. We're scheduled for like 18,000 unit completions in 2023's first half, which, we're seeing a majority of it in the first half. And whether that gets absorbed in the rental market, the resale market, or the assignment market, we're going to have to see. So when we dive further into, like, say, the population growth over here, especially the non-permanent residents, a large majority of them are international students, which, I talked about before. Kind of like the Canadian citizen dream goes like this, right? You come as a student, you get a student visa, then eventually you graduate, you get a work visa, then you apply for PR, you become a young, productive, working Canadian citizen at that point, and then you kind of have a better life, and then Canada increases their GDP, so it's a mutual relationship. Now, my problem with that is that the international student growth has been so big and so astronomical that it's kind of skewing things a little bit. Because you can see over here in the last 5 years, we've almost doubled our international students. The universities and colleges don't really have the responsibility to house all these students when they do come, but they are the ones responsible for their admission and letting them in. And you got to remember this. The international student tuition is double, therefore their revenues are double of, like, call it the local students, and it creates a larger demand for the rentals near universities as well. And I'll say this, I do think it's a problem for the infrastructure and often a problem for the students as well because living standards are pretty crappy at that price point. Now, I actually think this is a deliberate move by the federal government because if you look at this, the students are now kind of allowed to work more than 20 hours a week. So why is this important in my mind when I look at the macro picture? It's because the government, I personally think, is definitely afraid of a wage price spiral, which if CPI is up, people demand more wages because the cost of living is higher, which means that eventually when that happens, the input cost for creating those goods and services also increases, which means inflation goes up. You see, right? How do you plug that hole? You introduce cheaper labor into the market, a la students. Hence, they're allowed to work more than part-time now. If you don't believe me, just look at this, right? Like, do you know why the average income to like average household price in Canada is so out of whack and we're, like, as Toronto, constantly ranked in the top 3 by the UBS bubble report? It's because our incomes are terrible. Canada is terrible for this stuff, right? So if you have a look at here, the average wage growth in Canada in the last 20 plus years is around like 2%, which is like barely beating inflation if you average it out because we've got some wacky ones in the last 2 years. Now, if you look at the US side, it's close to 5%. So the nerd in me, I'll show you the example of why this is important, compounding effect. If you calculate it out, say, a person who was in year 2000 making 100 grand in Canada, right now with wage growth, it would be 150 grand. And that person in the US is now making 295,000, which is how big of a difference it is to have such low labor increase. So by bringing in cheaper labor via students into this country, we're effectively kind of like band-aiding, paper overing the labor shortage and the lack of wage growth and preventing that wage growth from going up, but still ultimately increasing the GDP. But the problem is its GDP per capita or per person is actually going down. Effectively, the real estate market is going to be seeing like a bigger and bigger demand for real estate, but we're not providing enough ability, call it financially, to buy that real estate, hence creating a bigger and bigger wealth gap, because in situations like this, where rates are high, crises are happening, the people who are most affected by inflations are on the lower income, and therefore the rich who have money, have capital, will get richer because they can have access to different forms of credit to kind of buy bigger things and to manipulate to their advantage. Which is why I've always said that the biggest driver of real estate prices is availability of credit. Which now leads me to, let's talk about the availability of credit, right? So despite kind of like all the people who said interest rates were higher in the 90s, if you look at this chart and you kind of layer in the relative amount of like outstanding debt, the tightening cycle, meaning how quickly the rates have gone up, we've experienced in the last year in 2022, is the fastest ever by quite a bit. And you can see that that thing just goes straight up on our side. Now, obviously, this is because the debt to GDP is much higher now, given that, before real estate prices aren't as high, right? Because we've effectively like quadrupled our prices in the last 20 years. So if you look at the household real estate asset to GDP, it's slightly off record highs from last year, but it's still very, very high and much higher than when the US had their kind of financial crisis in 2008. This means that Canadians are really, really, really heavy into the real estate asset. And if and when it tumbles some more, it'll affect a lot of the spending because of the negative wealth effect. So, are we as Canadians, in over our heads on the mortgages? By this data, I would say yes, right? But the question is, are there that many people that's going to default? Well, it's hard to say because if you look at mortgage delinquency rates, it's kind of like a lagging indicator, right? Because it takes, you not paying your mortgage 3 times before it counts as being delinquent. So that data is always going to be 3 months behind at minimum. So generally, we try to look at credit card and how much credit is being used. You can see over here, since 2022, last year, the credit card utilization has increased. And I would say the savings that most people had from the pandemic and all the helicopter money were slowly sapped away because of inflation and the rate hikes that Canadians have started feeling. And that's why they started using a lot more credit card loans to make ends meet. However, the credit card delinquency rate is still relatively low, as you can see over here, but it is increasing. Low, but increasing. And if you look at the stuff over here, which is the consumer insolvencies in Canada, still very low, but also increasing. And the same can be said for business insolvencies. Low, but also increasing, which kind of gives you a little indication of there is a little bit of stress in the financial market. So what about like actual mortgages? Right now, it's actually still super low. It's sub 0.2%. But remember, it's a lagging indicator. Now, to give you some reference of how low 0.2% is, if you look at the great financial crisis in US, it was as high as 11.5%. Canada is 0.2. What about Ontario? Look here, 0.1. That's how serious Ontarianians are about paying their mortgage. That difference is 115 times. 115 times. So look, this isn't to say that we won't have tons of power of sales, because I'm seeing them come up already, and there could potentially be a lot of pain coming our way, especially if like a recession hits and job losses are, happening, right? But our baseline of where things are starting from for delinquency is so low right now. So if you see like headlines coming about like mortgage delinquency rates have doubled, that means we've gone from 0.1 to 0.2. It's all relative, right? See what I mean? So we do have a long ways to go. And, for us to even see something similar to that of like the great financial crisis in US in Canada. But that isn't to say that we aren't going to get pain. It probably will. It's just how much. Now, the interesting thing about the delinquency rate for a credit card is that those who actually have a mortgage have less credit card debt and less line of credit debt and less card debt. However, those without a mortgage are having more debt. So this could be like either they had their house fully paid off or are renting, and of those two, they're starting to default on their debt in the last year. So My thought process on that is that the mortgage-free homeowners are using their homes as ATM, which is not a surprise to me as a Canadian thing. And or this is kind of another example of like, the K-shaped recovery, right? Because those with assets can maintain a better balance sheet and their cash flow better, especially in times of inflation, than those who don't have assets, which is similar to what we saw in the pandemic on the K-shaped recovery. Now, where I've always said that we'll start seeing power of sales has always been in the private and B lending space, so the alternative lending space. Basically, like, not one of the big banks, right? So if you look at this chart over here as a percentage of people who have successfully gone from an alternative lending space to a big bank, because that's kind of what most of their plan is, that percentage is shrinking and shrinking. And the percentage that's actually renewing at that same lender or maybe a different one is actually growing and growing. Now, this is because the rates are higher. So the stress test can't actually be passed by those borrowers right now. And who a lot of these borrowers are right now are the people who are doing BRRRRs, they were self-employed, and they were using these alternative spaces because they didn't have any other option, right? So one of the things about those people in those boats is that they don't even count for the people who had to use privates again, for maybe someone had to do a flip, or maybe they ran out of money. And those privates sometimes are renewing. Again, this is a very small subset of the market, but if they were to fire sale, in theory, they could bring down the average price like what we saw in June 2022, where you have massive big drops over and over again because they had to sell. And I've been saying this for a while. Those of like the 1 year B lender rates that took it last year around this time was at 5% because they took them because they bought first. And now they're renewing in the second quarter of 2023 at much, much higher rates, like 8%. That's why if there were some stress, it's going to be coming in that subset of mortgage holders. However, the interesting thing, if you look at this subset of data from CMHC, is that the delinquency from the mix, which are the mortgage investment corporations that do sometimes provide the alternative lending space, they are often looking at the delinquency rates right now dropping, which is really strange. Now, keep in mind, this is data from second quarter 2022, but their delinquency rate is not at 1.34%, much higher than your normal ones, but still relatively low. And you can see that the rate that they're lending out at is around 8%, which is quite high. But what's providing what I would say like stability in the alternative lending space is that the loan to value isn't high. It's 60%. Normally, conventionally, it's 80%. So I would say it's relatively safe. My problem with this is, where's the other 40% coming from? If it's from a private, yeah, we're gonna have some big problems there. See what I mean, right? Every situation is gonna be different, right? The question that nobody has an answer to is, how many of these are going to come to the market in the second quarter of 2023? And whether it's going to be a large enough of these listings that need to list. Remember, that's going to increase the inventory to drive the prices down and have to fire sell it, right? Nobody has an idea. Now, here's an example of something that I was just mentioning to you, right? I would say it's a pretty good deal. Here's the kind of backstory of it. The lot was severed to build 2 custom homes in the last few years. This is in Richmond Hill in a pretty prevalent area. And they effectively just ran out of money and they couldn't finish the house. There were 6 mortgages on it. Yes, you heard me right. 6 mortgages, which is absolutely wild. And they did eventually, all of them executed some form of power of sale to recoup their money. But look, it sold. There was a price floor on it, right? Somebody bought it. And I would say that the value of this house relatively, in that time of the year was probably, if they were to finish it, it's like somewhere around 2.8 mil to like 2.9. That's assuming they finish it. But you could tell that in a depressed market in December, 2 people stepped up and bought it firm, no conditions. So the question is, are there going to be enough of these examples, that many of them out there, that's going to cause a new bottom over and over and over again because people have a liquidity problem? Is there going to be enough of these power of sales in 2023? Nobody knows. And the other question is, how many people can't hang on? And I'm going to provide you kind of with an update as the market starts moving again next week. But at the moment, like I've been saying, it's always best to look at the inventory because I just recently talked about the macro, but you got to look at the micro because that's where the action is happening right now. But the macro drives the micro, and which is why we'll see it reflect for us in the inventory. And that's why I'll always look at the month's inventory, how many listings are coming, how many are actually selling. And that's kind of where I'd say let's wrap this video up. It's a little bit longer, but I just wanted to kind of provide you some data that I'm looking out for in kind of 2023, all the trends and all the other stuff that's out there that may shape this year. And despite all this data I'm showing you in this video, there are always going to be things that you can't predict that could happen that ultimately like sandbags you, right? And it's our job or your job to make a business case and a percentage of probability on how to mitigate risk for your own personal situation. And everyone's personal situation is different because everyone's risk tolerance is different. So if you are looking for some help on how to navigate the real estate market, especially in 2023, now that you've seen how nerdy of a deep dive I've got into, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Happy New Year. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.